Vanguard came out last week with their 2022 market outlook, and I took some interesting notes from the call that they did as well as the PDF that they issued. It's interesting that to me that they're talking about stock returns. They expect U.S. large caps to be up 3.2% this year. But in the large cap space, we have value and we have growth. And they're really thinking that growth plays over, that growth stocks are going to be flat for the year, while value stocks should have a higher return of around 4.1%. Vanguard for the last decade has always thought that foreign stocks would outpace U.S. stocks. They've been wrong almost, every single year. So they're still showing a 6.2% increase for foreign investments, as well as a positive increase for small cap stocks in the U.S. of around 3.2%. I think the most interesting thing, takeaway from the call was really inflation, because we're all sitting here looking at crazy inflation right now, especially in auto and home space. Gasoline, anything related to travel has gone up significantly in the last 12 months. Vanguard sees lower inflation by the end of this year, and that's pretty consistent amongst BlackRock and some of the State Street things that I've seen as well. But they do believe that wages will continue to increase and housing will continue to stay higher as well. And this sort of makes sense, especially on the housing front. I mean, we had a really big increase for the last few years, but if you look at the data going back to pre-financial crisis, on average, home prices are still up around 4% each year on average. We just had a huge depression there, and we're sort of just now recovering from that, getting back to the standard home price inflation rate. Valuations, they think that foreign and small cap stocks and value stocks here in the U.S. are fairly valued. They see emerging market, large cap U.S., they use the word stretched, which really means overvalued, I guess. Bonds, they see low interest rates, low returns going forward, but still a positive rate of return from the bond side. The U.S. aggregate, which represents the entire U.S. bond market, they show is fairly valued right now after being down about 3% over the last year. TIPS, short-term treasuries, all undervalued. And then long-term treasuries and mortgage-backed bonds is being overvalued. Pretty much everything that they talked about was over the next decade, they forecast lower returns. I will say over the last decade, they also forecasted lower returns. And so whenever Vanguard, BlackRock, State Street come out with their economic reports, we always read those, we pay attention to those. But really my takeaway was just be invested in large core asset classes like all large cap stocks, not segregating them out, all small cap stocks, not segregating them out between value and growth. And then the diversifiers, real estate, emerging markets, foreign, developed, all the diversifiers play an important role in a portfolio over the long term. But certainly in the short term, we're not going to be selling those because maybe they're not as valued as well. Something else that was not brought up, which something that I've noticed, there's a XAR, it's an ETF that tracks aerospace and defense stocks. That stock ETF has been up a lot over the last couple of days because of what's happening in the news in Russia and Ukraine. And obviously we're monitoring that, but we're not making portfolio changes based on what might happen. And if something does happen, more than likely you're better off weathering the storm through U.S. large caps and then U.S. short-term treasuries inside the portfolios. As always, we continue to monitor, my team here and I continue to monitor what's happening in the world so we can understand what happens to our portfolios in the short term. But long term, we're looking for diversification, low cost, and broad asset classes inside of our portfolios.